Hey there, Steve Rubis with another installment of Capital Markets Investor Relations in 2 minutes or less. Today we're going to talk about the 23andMe board resignations that were announced this week and what you can expect when your stock ends up below $5 and how a scenario like this will play out over time. So what happened? Well, 23andMe announced that 7 independent directors of the board resigned. Essentially, the entire board resigned because they rejected a 40-cent takeout offer from the founder of the company. They complained that there was no premium to the 40-cent share price, and they felt that there were no real financing mechanisms in place to make this a legitimate deal. Now, the problem is when you're a stock that's 40 cents and you're a SPAC and you've seen a lot of value destruction over time, a take private offer is essentially the last lifeboat off the Titanic. It's almost impossible to turn this down because a better offer is not coming, and you're most likely going to go bankrupt and become a zero at the end of the day. So what happens when your stock goes below $5 and even goes below $1? Well, first, mandates are going to force significant sales amongst your institutional shareholder base. They can't hold stocks that are less than $5. And it leads to the second issue, which is this idea that there's no longer liquidity and an ability to take size. You're not knowing when you're going to be able to get in and out. Shares may not trade as easily, and it becomes a difficult position to hold. And finally, when you go below $1, essentially, you no longer exist as a company in the consciousness of a lot of investors. They just can't own you. Now, if you're an executive going through this, the feedback you're going to get from investors is pretty ugly. And they're going to say things to you like, the business will never recover. You're never going to improve this business. There is no hope for this business. And why did we hire this management team? And ultimately, they're going to tell you your best outcome is to sell the stock and accept whatever you can get for the business. So if you're a public company executive going through something like this, what are the key learnings? And there's 2. The first is that no one has unlimited liquidity to fix a business. And secondly, you probably don't have the talent or the resources in place to fix the engine of the airplane as you're flying it. And for those 2 reasons, once your stock is below $5 and under $1, you've got to accept that takeout price because it's really the best outcome for all shareholders involved. Remember, when investor relations is too tough for you, it's just right for me, and thanks for watching.